All right, should we get started?
Yeah, sounds good. Yeah, so welcome everyone to today's webinar. As I said earlier, quite an interesting topic that I think not a lot of people have consciously thought about or consciously created content about. So we're trying to kind of patch that hole, but everyone's working with them. So pricing KPIs. What are you actually measuring to be successful, and why that matters, and how you should go about it. And I think we have some very interesting examples that we brought with us on what can go wrong and how to do it a bit better. If you want to go to the next page, I can quickly introduce what we do at Buynomics before then Ingo takes over as our host. So yeah, I'm Paul. I'm head of sales at Buynomics. I'm leading basically the Buynomics content and insights. Previously worked in consulting, and yeah, kind of here to moderate today's webinar. And Ingo, do you want to do a quick intro of yourself?
Yeah, just very brief. So my name is Ingo, co-founder of Buynomics. Long history in pricing before founding Buynomics, and I'm happy to discuss the topic with you. If you have any questions, please write them in the comments or in the chat, and we will go through them at the end of the webinar.
Great. So let me show you on the next slide what it is that Buynomics does in a nutshell. So just very briefly, we are a SaaS company founded by Ingo and his colleague Sebastian a couple of years ago. These guys have extensive experience in pricing, but also in everything relating to what you might call revenue management, anything around the offering. And they thought that there's a new solution needed to do away with Excel and very inaccurate alternatives. And that's why they created this Buynomics software using virtual customers, which forecast your shopper and buyer behavior with very high accuracy. And once you can do that, you can optimize stuff like your prices or your portfolio quite easily. So that's the strength of our AI solution. And we're currently working a lot in the consumer goods space, internet, but also software, telco, and other consumer goods. So we're proud to be represented worldwide and hope to expand that even more. With no further ado, I'll hand it over to you, Ingo, to get us started on the topic. And I hope that everyone has a good next 30 minutes.
Yeah, I hope so too. I will do my best to contribute to that. So before we get into pricing, I think it is helpful to first talk about the role of KPIs. And to me, it's always the easiest way to think of that in the context of sport. Here, I think it's probably one of the most famous example based on Michael Lewis' book Moneyball on baseball. There are other, of course, there are examples in all kinds of sports. Myself, I'm more familiar with soccer, so there are similar examples, but I think this one's very instructive. And probably most of you will know the story behind the book Moneyball. The idea was to identify essentially KPIs that help you decide which players in baseball help you win games in the end, and by what measures you can identify these players. And one of the measures that were widely spread before the book was, for example, stolen bases. So players were considered very good who were capable of stealing bases. If you looked at that in more detail, what you found is that players who stole a lot of bases also tried a lot, and most of the times they failed, and it turned out that in the end that wasn't a very good strategy. And what was a much better indicator of success of a player was the on-base percentage, so the share, so how often the player reached the first base in the game. That was a much better predictor of success of the player. And when putting together a team, this is one of the key metrics or KPIs in our terminology to look for when deciding what players to get. And you have in other sports like soccer, it's important, for example, not so much how long you're in control of the ball, but for example, it would be much more important how many major opportunities you achieve during the game than actually scoring a goal. It can be a bit random in the end, but overall over the season, that's one of the large determining factors of success of a team. That's how many opportunities it achieves. And why are we talking about baseball and soccer here? When this webinar is on pricing. So the analogy, and that's important, is that you identify KPIs that help you achieve your overall goal. And in price, and to highlight this example, let's look at a very simple example. So for example, you have an organization that has different sales reps, and from a pricing perspective, something that you might be looking at is the average selling price of the sales rep. And you say, okay, a sales rep is successful when he or she is able to achieve a high average selling price to customers. And you might say in this example, this first salesperson here is very successful because he achieves the highest selling price. But it turns out that as a consequence of this high selling price, the success rate of this first sales rep is much lower than for his colleagues. And it turns out that in this example, he achieves a much lower performance than his colleagues. So in this context, average selling price would not be, at least not in isolation, the proper KPI to steer the selling team. And while this example looks very trivial and everyone would say probably, okay, that's obvious, we won't do it. Something of that logic is implicit in many pricing tools. For example, if you are aware of things like peer pricing, where a solution or a method looks at the prices that is achieved by colleagues, and this is set as a benchmark for your own pricing, then this logic here, looking for the highest selling price, is implicit in such a method. So even if you're not actively using such a KPI, for your pricing, you might implicitly do it because you're using a tool like peer pricing that is based on that logic of looking at what price colleagues might achieve. So that's very important. So as in the baseball example previously, it's very important to have the proper and the right the right metrics to measure success in pricing, and then allow your organization to achieve the proper objectives. In this example, for example, you wouldn't look at pricing in isolation, but you would need to understand how price, margin, and success rate are related to each other. So you need to have an understanding essentially of the demand curve for specific customers, and based on that, you would have to identify essentially, or give your sales team guidance and what the optimal price would be in that situation, and what essentially the optimal margin would be to set the pricing. And not the highest price, not the highest average price would be the right thing to aim for in this example. We in the previous week, I think, and some of you participated in the survey. Thank you very much for that. We asked what colleagues in the field are looking for when they, or what pricing KPIs they use, and what we found was not I would say not very surprising, is that most of us use simple KPIs, something like price increase, revenue increase, profit increase, and I think particularly from consultants, they're pushing more advanced or more sophisticated KPIs like price quality, price maturity. But we're seeing that that few people are actually using these price metrics, and I think in our view for good reason. Some of these more complicated, sophisticated metrics are very have some challenges. For example, pricing quality is typically something that measures how close a sales rep in the previous example is to the sort of optimal price that can be achieved in a situation. And you can only compute something like a price quality assessment or KPI when you actually know what the optimal price is, and that can be difficult to assess from the outside. So most people are looking for simple KPIs, and that's the status quo where we are at the moment. So to put KPIs in a context, I think when deciding on the KPIs, it's important that this can't be done in isolation, but it can only be done in the context of the strategy. So again, when we use the sports analogy, in sports, the objective in a game like baseball or soccer is very straightforward. You want to win games, and you need to understand what you have to do to win games. Likewise, in pricing, the overall objective is something like profit optimization, long-term profitable growth, for example, market share, whatever the overall objective is of the organization. And then as a pricing professional, you need to understand how pricing can support achieving this overall goal. And that means understanding, for example, in the previous example, how the right price is connected to profit optimization or whatever the overall objective is. So that means you first need to understand very briefly, and this is something we used in our pricing strategy webinar a couple months ago as a framework. I think it's from a strategic point of view, it's what I find this to be one of the most useful frameworks for actually deciding on the proper strategy, not just in pricing, but overall, but particularly for us, we're interested in the pricing strategy. And then the question is always, how can pricing support the overall strategy? If the overall strategy is market share growth, then we can't have a profit maximization pricing strategy, but one that supports market share growth. If the overall objective is to achieve profitability, then of course the pricing strategy also needs to aim for profitability. So these need to be aligned, and how to achieve that, and we will look at that in one or two examples later, is then the core. You need to understand your business, what drives success, as in the baseball case. So is it stolen bases, or is it on base percentage? This is something that needs to be understood in the pricing strategy and then implemented via the appropriate KPIs. And from our point of view, and this is at this level here, a bit independent of the specific industry, I think what is a very useful for, and it's a general framework for all of these pricing decisions, not just KPIs, but also how you want to set up your business, but then to implement and manage that, you need to have the same, or should have the same structure also in your KPIs that you're looking for. And that means you need to have an overall objective, something like profit maximization that you want to achieve. And then with your pricing levers via, for example, price setting, so setting list prices, for example, price implementation. So for example, how much discount you give to different customers, how much price variation you allow, essentially price implementation. You need to steer these, and also to support your pricing organization, the question of what's the proper technology you want to use for your pricing, what are the proper processes you're aiming for, what's the right team. All of this needs to be also measured using the proper KPIs to achieve overall success. So in the end, you want to achieve what you define as your pricing objective in the beginning. And then the question is, what's the best way to achieve that, and what needs to be measured to ensure that you're on the right track and you're doing the right things. I think that's the overall framework. And then what the proper KPIs are for each context, and what the values are that you're aiming for, that very much depends on the context and what's achievable in a context. So in one case, a profit increase annual by 2% is quite a lot. If you're in a mature industry with an established equilibrium price, that's very different from a new industry where you can achieve, or where the market price hasn't settled yet, and you can aim for much larger steps, but also in the context of much more risk than in an established industry. So this is I think the overall framework we're working with, and we've done that in a number of cases, and I think that's at least from our experience what's most useful for setting up a KPI system within a pricing organization. And there are, of course, different overall objectives that you might aim for, but it seems to me that the most useful is always, at least from a pricing perspective, long-term profitability, so the maximization of long-term profitability. And this is also what you want to achieve in your organization as the overall objective, and that's, I would say, equivalent to winning games in baseball or soccer. How you achieve that's then the question. And that can, for example, also at a top level be done with KPIs that you're aiming for, not in the very long term, but in the midterm, is something like profitable revenue growth is what I see in most cases organizations are aiming for. So they have a growth trajectory. Maybe their revenue growth by, I don't know, 3 or 4% per year, and this is what they're aiming for in their overall pricing target. They might also aim for a certain market share, or aim not to lose market share below a certain threshold, and that's the overall objective they're aiming for. And then the question is how to best achieve that. And I think what's important is, while this is the overall objective and sort of the most important KPI, it's one that cannot be directly affected with certain price measures. So your levers are prices that you can increase or decrease. You can, to some extent, add products, remove products, change products. You can change discounts. You can change how you run certain promotions, but you can't directly affect your profit, but you can only affect it through these other levers, and they need to be properly aligned with the overall objective. And the things to aim for, and this is I would say that the core of the what you do in pricing is the price setting. Price setting is more aimed at, for example, the list prices, the end customer prices you're aiming for, and they're the typical KPIs organizations are looking for are, for example, price increases. So by how much are you able to increase price from one year to the next? Things like the total margin, if you're working, for example, with retailers, at that level, the question is how much total margin is there between you and retailers, wholesalers in between, that needs to be optimized or measured as a KPI. Then revenue or profit increase total, that means at this point total revenue and total profit increase. And then also what's from a pricing perspective always an important aspect is, because we can't affect everything in terms of revenue growth, but the question is how much of the overall revenue growth or profit growth comes from pricing, how much comes from, for example, advertising, marketing campaigns, how much comes from product improvements. And that's always something that's important for the pricing team to understand, is how much did they contribute via an optimization in their price setting to the overall company success. Those are from our point of view, the most relevant ones. And if you see others that we're missing, please add them, write them into the comments. We're happy to discuss them at the end of the webinar. Then the second level, for example, think of a consumer goods company. So you set your list prices, you have the end consumer prices, and you want to understand how to split the revenue, the profit between yourself and the retailer. So there are the key indicators, the key KPI, the key performance indicators that are relevant here are the relationship of, from our point of view, list versus net price increases. So it might be you increase your list prices, or the end consumer prices are increased by 5%, but the net price only by 3%. So you were only able to implement 60% of the price increase, and the rest of the price increase went to the retailer. So that's not a problem in the end of your price setting towards the end customer, but that might be a problem of in your relationship with your retailer and your ability to properly steer the discount system. So that's something important to measure. Also closely related, typically the margin share between you from a perspective of a manufacturer, retailer, wholesalers maybe, and also things like more tactical, when you run promotions, you need to understand the return on investment for these promotions. So how much you spend on your sales in relation to how much you get out of these investments in promotions, for example. Then last but not least, and these I think are often forgotten, are the pricing metrics to assess how well the pricing organization works. One, and we put it at the top, I think, because we are a pricing technology company, and this, from our experience, is getting more important, is the question of how well are you using technology in your pricing. And it can be something like you're making a prediction on the demand reaction to a price change. That means you want to know what happens if I increase prices by 7%. And you want to understand how precise your prediction is, because if you have a precise prediction, then it's much easier to identify the best pricing moving forward. Also important here is how much of your overall pricing process is automated. Ideally, at some point, a lot of the tedious work, assessing different scenarios and so on, can be automated, and the pricing team then only needs to work on the most relevant and effective tasks, and can do all the laborsome work, delegate that to a system, and focus on the most important things. Also, from a process point of view, is always the question, how much time do you need, for example, to renegotiate contracts? How long do you need to optimize your new offer? How long do you need to find the new pricing for your system? And also in terms of team, for example, if you have a sales team, how much revenue and how many price changes can you manage per team member? So there are a range of pricing organizational KPIs that are relevant for running a proper pricing organization. These are, of course, only a selection, but these are the ones that, in our experience, are the most relevant ones. Let's look at some quick examples. We will share the slides afterwards, so we won't go into too much detail here. So when we look at for example, a consumer goods company, and then of course they might at the top be aiming for annual profit growth or a certain market share, and they do that via setting new list prices and customer prices for their products. And then the question is, by how much were they able to increase the list prices, and how much were they able to increase the overall revenue on a price setting level and implementation. Then the question of how much of the actual end customer price were they able to capture on their own. And also, of course, always important, return on investment. So how much did they gain for each dollar or euro that they invested, for example, in promotions? Different context, if you're looking at a recurring business, so for example, in telecommunications, software, and so on, then the most important is the customer lifetime value. So how much value can you get out of a customer? And the key metrics for pricing that result from that are, for example, the take rate. So what share of the customers that look at your offer will buy something in the end, and how much will they spend on the product. So you typically have something like a good, better, best offer. And you, of course, want to set your portfolio in such a way that people tend to buy the more upgrade offers within your portfolio, and spend more money, because in software or telecommunications, revenue and profit are very close to each other. So this is important at the beginning, and then of course at a later stage you want to minimize churn rate, and there are also things in pricing you can do to reduce the churn rate, like giving high discounts, offering new products that fit very closely to the needs of a customer. And also what's important here as a KPI are what share of your customers are you able to cross-sell, upsell, and by how much can you increase revenue for these for these customers. Looking forward, the question is, where does this end? And I think, as we said in the beginning of the webinar, we can't cover everything on KPIs within half an hour. But what we want to achieve here is to I think different things. So with the sport example in the beginning, raise awareness for the fact that it's important to not just measure anything or the most obvious things, but measure what matters to achieve your overall objective. In the recurring business, those are certainly customer lifetime value, looking at churn, revenue per customer, looking at how much upsell you can achieve, and so on. And I think moving forward in the field, and this is just as an outlook, we will not fully discuss this here today, but I think what we see, and it's driven by consulting companies, are more sophisticated KPIs that try to overcome the shortcomings of, for example, an average selling price, as we had in the initial example, by replacing it with something like a price quality that aims for comparing the price a sales rep sets with what some system or some method thinks is the optimal price. And if that works, that I think that's very good, but it has the challenge that you need to know what the optimal price is. And the second way forward, and that's where we are putting most of our money, is in technology. That means having a system that allows you to easily make the inferences between certain simple KPIs like average selling price and the overall outcome, and also the relationship between different KPIs and how together they best work. So, for example, churn rate and revenue per customers, these can be optimized in tandem, for example, using the solution that we are building. And this offers the opportunity to not just look at simple or individual KPIs, but understand how they best work together to achieve the overall success. And if you're interested in that, we're very happy to give you a more detailed tour on how the KPI topic can be covered with proper technology.
Great, thanks, Ingo. As you all know, we make basically all of our webinars from scratch each time. So we try to make something new, and so we're running a bit out of time today, but that's only because we try to be very ambitious in the topics that we cover. I have one question from Norbert, who's asking, how do you isolate discount impact on revenue or return on investment? Is it a different method with proper dynamic control groups in A/B testing? So I think basically he wants to figure out how to isolate the impact of discount on revenue, because I think there's lots of other things going on, right? So you need to kind of figure out what the individual effect is, or how big it is.
So that depends a bit on the context. So like in software, this is something that can be done with A/B testing. So for example, you have a price of 100 euros and you want to test what's better, 100 euros list price and a 40% discount, or a 60 euro price, list price. These things that can be tested, and we've done that, and we also have some insights on what works best in which situation. So this is something that can be done via A/B test in some cases. In some other cases, like consumer goods, you can you typically have a lot of different weeks with different scenarios, so that you have weeks where one company runs a large promotion with a high discount, and then another company runs a different type of promotion in another week, and so on. And this can be assessed. That's, for example, that something that we do with almost all of our customers in the consumer goods area. So how you determine it depends on the industry. Let's say we have the techniques to assess these different effects that are appropriate and relevant for each industry.
Great. So I think we're a bit over time. We have one more question regarding the KPIs that we already include in the tool that was asked in the Q&A tool. So you can also ask either in the chat or in the Q&A. So Ingo, what KPIs do we have in the Buynomics solution?
Just very quickly, we have, and that's also why we had these two examples. One with like a recurring business. We have the KPIs that are usually used in a recurring business, like lifetime value, lifetime revenue per year, and so on, revenue per product. We can show all of these. And for other non-recurring business like consumer goods, we have the relevant KPIs that are used, that are based on revenue, profit, sales, also how many not just units but kilograms of the underlying product are sold. So I would say we have the 95% that are always relevant, and we're open to adding further that might be relevant, or we can actually calculate some within the tool if these are needed.
Yeah, great. I think I see no further questions in the chat. I'm sure people have lots of meetings on the last day of the week. Someone's asking whether they will get the recording. Yes, everyone will get the recording by email if you registered on Zoom or on LinkedIn. Otherwise, sign up for our newsletter, then you will get notified whenever we have a webinar. And yeah, looking forward to seeing you all at the next one. Ingo, what's the next one? Can you show the slide very quickly? I think we have an interesting one for everyone interested in pricing horror stories. So this is kind of our working title. I think it's going to be about what can go wrong in pricing, and yeah, how to do it right, of course. But we're going to debunk some myths, and hopefully in that pre-Halloween webinar on the 29th of October, we'll have some interesting, funny, and insightful anecdotes. And then for our CPG customers, we're also having one on innovation and disruption that will be quite interesting. And we might do it with a new partner that we have. So we haven't announced that yet, but stay tuned. And yeah, if you found this interesting, tell your colleagues and friends about us, and follow us on LinkedIn. You'll get the recording as always, and as well as an invitation to the next webinar. So check your inbox, check your spam box if we landed there, and hopefully see you next time.
Thank you very much.
Thanks,
Bye.
Ingo.
Have a great weekend. Bye.